for this below 60%, right around 58%, and even dips more on the subsequent attempts. And I say that not to intimidate anybody, but just to let you know, if you take this 4 hours serious, you really actively participate, you're going to be in great shape. And I'll go over some stats and in the sense of how many times Scott have gone through this presentation, and then some correlating results as well. But again, excited to have you. Take it seriously, have some fun, and this will make a huge difference in really jumpstarting your MLO career. So let's talk about.
Can I just interject for a second? Just want to make sure before we go to the next slide that this is you guys are recording this, Michael?
Good call. Let me go ahead and hit record. Yes.
Okay. And the second point is the Homesite crew here just wants to help kick it off, and we're probably going to move on at like 10 o'clock.
Recording in progress.
So just FYI.
Oh, so what was that about 10 o'clock, Darren?
The Homesite crew is probably going to cut out at 10 o'clock. We just wanted to make sure it kicked off well.
Okay. Gotcha. Okay. And since we're recording now, I'm just gonna repeat that for those who may view this later, in the sense of very crucial 4 hours. Again, I'll go into some stats in terms of Scott's results and number of times he's gone through this. But for those just now viewing, again, the first time pass rate, it's just around 58%. However, we feel strongly that, and even then, on subsequent attempts, it dips to below that 58%. However, we do feel that after going through this next 4 hours, you're going to be in great position. I'll show you what we're going to cover here momentarily. So really take this seriously, be as engaged as possible. And with such a small group today, I really encourage you guys to ask many questions. Don't allow us to progress through this deck until you feel confident in the content as well. So again, going into today, keep in mind, we have 4 hours. That's a lot of time, especially with the small group. So we will take breaks, 10-minute breaks at 10 till on each hour, right? We do encourage as much engagement. Take full advantage of this time. You've gone through the 20-hour content, but keep in mind, that's the content that the NMLS requires you complete prior to sitting for the exam. And even though it's a great head start, most people feel strongly that going through the 20-hour course, while it will satisfy the education requirement, may not be a thorough exam prep preparing for the federal exam. So again, you've completed that, but really take advantage of this. In addition to this, you guys should have received emails for your online exam prep edge course too. If you did not, please let me know. You should have my email address and the meeting invites, but you guys should have that along with the login information. And that's going to be great to visit after this course, because there are plenty of practice exams. And Scott may touch on this a little bit later as well. But when you first dig into that online edge exam prep course, there's going to be a simulator, and it's going to tell you how you've scored and your level of perceived readiness for each core section of the exam itself. So there's great content in there. But really the 5 core sections of the exam content outline that we're going to cover today: federal law, general mortgage knowledge, loan origination activities, ethics, and uniform state component. Scott's going to dig into some test taking tips and resources. And again, with him being a licensed MLO today, and gosh, I don't know, Scott, correct me if I'm wrong, but probably over 15 to 20 years experience as an LO as well. We're going to go over plenty of real life application scenarios. And again, plenty of Q&A throughout, but we'll also have a dedicated block for Q&A at the end of our session as well. So before I kick it over to Scott Genzer here, let me tell you a little bit about this gentleman. Again, currently a licensed MLO. He and I have been working together, I think, for probably over a decade at this point.
Right at that.
Yeah, and we've done. He's taught. I haven't taught, but have had the opportunity to sit in many classrooms throughout the day and check in. and it's been great to kind of glean information from him. But in terms of his experience level, just in the 20-hour pre-license course alone, we're at over 5,000 students and counting. When it comes to continuing education, that number sits at over 10,000 and growing. And when we look at exam prep, I don't remember what that number is, but we're probably well over a couple of thousand there as well. When it comes to number of loans that's kind of been a part of, whether it's in the form of loan originator, branch manager, regional vice president, that number sits over 5,000. And I think what's really great about Scott, and one of the things that always sticks out to me every time we have the chance to interact, is his passion for really helping you guys jumpstart your new career, and not just today, but he's willing, if you have questions, you can shoot him an email, post exam, let him know how it went. And it's been really great to see that feedback from students, hear the excitement about passing that exam at the first time. That's certainly a milestone. And Scott, in that sense, has had a huge impact on the loan originator space. So without further ado, I will stop sharing my screen, and then I'll turn it over to Scott.
Awesome. All right. Good morning. Good morning, everyone. I am Scott, and hold on. Let me get, and I am a fumbling. Where did I had it open. I'm sorry about that. So good morning, everybody. Scott Genzer. I've been a mortgage guy since 13.5%, which it may be in front of us, but it definitely is behind us a long time ago. I've had a long career in mortgage lending, and in the latter half of my career, I still am an originator here in Colorado. I'm a partner with a company. A few of us have our own company here in Denver, and I as well do CE, the continuing education. Everybody has to do that. We're known for our fun and engagement in our CE classes, but more importantly, the pre-licensing education, as well as the exam prep. Hold on just a second. I hit my share screen, but I don't know why. I'm trying to get something moved here. There we go. Now we've got what we're doing here. So what we're going to do today, this is a great tool that's out there. There's a few different versions, but for the most part, this is one that I like to use, and it truly goes through exactly what is on that test. So they break it down. Your test is done in 5 categories. And and over the last couple of years, they've actually weighted it more evenly. The top 3, where we'll spend most of our time today, are federal mortgage related laws. I'll probably spend more time there today, and we're going to start the day with that, because nothing's more exciting than talking about federal mortgage laws at 7 o'clock or 9 o'clock in the morning. I'm in the famous mountain time zone, so it's a little earlier here. So we're going to go through each regulation that you guys learned about in your 20-hour. We're going to drill deeper in some of those. And as Michael said, in a small group, I like to have an open conversation for you guys to engage with me however you would like to, and however you're able to. So we're going to leave it open, questions, comments, and we're definitely going to try to keep you guys engaged. This class is for you. I don't know. This is one of the smaller classes I've ever done, and I like it because, all of us aren't the same. Some people grasp certain situations better than others. Some people are great at math. Some people aren't that good at math. There's not a ton of math in this, but we're going to touch on that today. It's always funny. Ever since you're a kid, there seems like somebody is always like, is there going to be math on the test? Yeah, probably. We'll talk about the test towards the end, but here's the main thing. When did you guys take your 20-hour course? Was that recent? How long ago was that? Somebody help me out.
Last week.
Last week. All right. Was it, did you have an instructor, or was it internet based? So you had an instructor. Okay. Live. Great. Which my favorite. So live. So your instructors are going to be a little different than me. Hopefully I'll give you a different spin on some of the information and some different ways to help remember exactly what it is we're trying to accomplish for that class. So federal mortgage law, general mortgage knowledge, mortgage loan origination activities, ethics, and UST. To me, the ethics is mostly pulled from the federal law and the loan origination activities. So it's basically going to be that in the UST, the Uniform State Test. We'll talk about a few things, hit a few of the highlights, but the main thing I want you to know is, man, if you just read what's in your text, that's probably going to sort it out for you. And as you can see, there are smaller portions of the test. So with that, who's got their exams scheduled? Anyone have their exams scheduled yet?
I do.
Yep. How long from now, Nick?
It's Tuesday.
Tuesday. Good. All right. So good timing for this. Anybody else have their scheduled? Is their test scheduled? Well, one thing I can say, the sooner, my history from doing this for about a decade now, I guess, on the CE or the PE here, is the sooner you get it scheduled, the sooner you're going to be ready for the test. I find that people that say, I'm going to wait till next month, my response is they don't do as well as, take the class, take the exam prep, do your studying, and go take it. So I encourage you, if you haven't scheduled your exam, that you go on the NMLS website after this class today, because I don't know when the earliest one's going to be available in your marketplace, right? You got to see when they're available, and you need to book that test and get ready to do it, because a month from now, you're not going to have the same retention of what you learned last week and today that you will next week. And that's been shown to be true for me over a long period of time. So I highly encourage you guys to do that. And all right, hold on. I got a dog opening the door. She must have thumbs now. Come on. Oh, all right. She's joining me. All right, so let's.
Scott, actually, Asura is also scheduled for Tuesday, so we're taking the same philosophy of sooner the better.
All right, great. All right, give me a second here. I'm going to. I want that. What? I want something else on my screen. I've got a double screen thing going here that I just added, and yesterday it worked fine, and now I'm not able to have what I want it to have, but because I wanted to see everybody's entire class, but I'm only getting one little strip, and that's not what I wanted, but I guess I'll work on that on the break. All right, so let's just dive into it. We'll talk about my thoughts on the test and some of the things you need to really be prepared for because you walk in, because it's a very controlled environment, right? You're going to be patted down. They're going to do cavity search. They're going to not let you take anything into that room. They'll give you the calculator that you need. And that's it. So it's a weird situation, the way they monitor it, and it's pretty strict. So what we'll do, let's get rolling into the RESPA, Federal Mortgage Law, first section. We're going to spend quite a bit of time here today. So if you can see this mortgage.nationwidelicensing-system.org, this is directly from the NMLS website. And one thing I want you guys to know, as far as a study guide, we can send this link out to you. When you get to the very bottom, there's hyperlinks to all the specifics. So if you want to drill into RESPA and see everything about RESPA, this takes you to that. If there's I'm not really understanding what that means, you can go into RESPA here, and now you've got, and RESPA is one of the most complete and the lengthiest regulations we have. It's just the absolute best information you could find about RESPA. So depending on where you find yourself feeling not as prepared as others, there are a lot more information out there for you guys to drill into with RESPA, with Truth in Lending. We're going to go in deep to the loan estimate and the closing disclosure today. Make sure we understand what's on page 3, right? It's an odd situation that we need to be prepared for. But if I asked you, on what section would you find the loan originator charges on the CE, you're going to want to know, oh, that's section A on the first page. Right. That's where it is. And we're going to have those tools for you to make sure you understand that. All right. So let's get into RESPA, right? RESPA, Real Estate Settlement Procedures Act. And one thing, when we say RESPA and we say TILA and we say ECOA, the first thing about any business is it has its own language. And the language is important to make yourself comfortable with the language that we're speaking. So one thing I like to do when I do the 20-hour, and we'll follow up here, is RESPA, Real Estate Settlement Procedures Act. Well, what does that even say? Well, settlement is another way to say closing, right? When we have a settlement of a transaction, that's kind of the end of the day. And it comes to everything that you can, how you charge, how you disclose, who the other people are. Settlement service providers. Have we heard that term? Right? We're going to need an appraiser. We're going to need a credit report. We're going to need title insurance. Those are all settlement service providers. So we want to make sure we understand when we say settlement service, what does that mean? Well, a settlement service is the ALTA lender's title policy that every lender requires when we do a loan. And when we do that, we go out and get a title company, right? So they're a settlement service provider providing a required settlement service, right? So we've got to talk about RESPA defines that what you can charge, not an amount, but no more than what the actual cost is, how you disclose it, and what the rules are. Right? RESPA is also, the act is called RESPA, and they call the regulation X. Right? And the first three regs we're going to go over today, first one being RESPA, it's just as easy for me on an exam to ask you, according to Regulation X, what is the maximum amount of a referral fee a real estate agent could pay to a mortgage lender? Well, what's Regulation X? Well, here's a first note of the day. And I don't use PowerPoints in this portion of the program because I want PowerPoints can make us lazier. I want good notes, good questions for you guys, right? So instead of just looking at a PowerPoint, I'm going to give you the guide. We're going to drill into what we're talking about. And then it's up to you guys to figure out, if you want to remember that RESPA, I say just remember RESPA. RESPA is RESPA, and there's your X, right? Because I can ask you a question about RESPA or Regulation X, and the answer is the same because it's one and the same. But it will say, according to RESPA and Regulation X. Well, why does it say and? Well, RESPA is the regulation, X or the law, and X is the rule. It's a weird thing the way they do that. They'll do the same thing with truth in lending. According to truth in lending and Regulation Z. All right, so RESPA, Regulation X. So just make a note, RESPA, and that's one of those things that will just stay in your head. Make sure you understand the difference. So the origin and purpose of RESPA. RESPA was created back in the early 70s, 1974. 1974 is going to come up a couple of times. And again, Scott, do I need to know that it was? And the answer is, if it's in the book, it could be on the exam. It's really one of those things. Now, they're not going to ask you subsection this and that, but I would want to know RESPA, Regulation X, 1974. And it was created that when people bought real estate, because it's a real estate settlement, real estate. So this only deals with regulations around residential real estate and the lending that we do. What are the settlement services? Who's charging for it? And how do you regulate that? Right. So before 1974, there was no common form that we used as a way to show you what your settlement charges were. Right. So in today's world, we use the LE and the CD. When RESPA was written, we're going to talk in RESPA, we're going to talk about the good faith estimate, which if we're doing standard residential lending, we don't use a GFE anymore. We use the LE. But RESPA required a good faith estimate within 3 business days of application. Right? It still requires a good faith estimate. But as we move later in the day, we know now in today's world that you guys have been through the 20-hour, unless it's an open-ended line of credit or loan on some land or a construction loans that don't allow for truth in lending or the TRID, the LE and the CD, we still use a GFE and a HUD-1. So in RESPA land, up front, they get a good faith estimate. And at the end, they get a HUD-1, which is what we used to call our closing statement, a HUD-1 settlement statement. Right? So that was the purpose of RESPA. One of the main things of RESPA, write down Regulation B. It's the only one in RESPA, the only regulation I want you to know, Regulation B. And they said, you know what? These fees are getting out of hand on real estate transaction because everybody's in everybody else's pocket. realtors are getting all these kickbacks, and the title insurance and insurance agents are paying kickbacks to the lender that refers them. And what happens if I'm paying a kickback to the real estate agent and there's other kickbacks involved? Typically, people just increase their charges to pass those along to the consumer. So the biggest thing, general provisions, it shows up later, but the number one aspect that can be asked multiple different ways is anything of value is not allowed between settlement service providers for the referral or expectation or the hopes of referrals, right? So all kinds of referral fees are anything of value, right? A lot of people go, oh, well, no, you can give them like a $25 gift card. You might get away with it, but in exam world, and today we're prepping for exam world, there is nothing of value allowed in exchange or in hopes of referral, right? I can't take a real estate agent to a Nuggets game because in hopes of them giving me business or for me pay for it. We can go to a game together, but it's illegal for me to pay for them in any way, shape, or form, because that would be a violation of regulation B or subsection B of RESPA. Okay, so let's go back to the top. Definition of a mortgage broker. You guys, mortgage lender, I'm going to assume direct lender.
We are a direct lender, and on that, the Homesite crew is gonna sign out. We just want to make sure we got kicked off nicely, and we did.
All right.
We appreciate everything, but we are a Fannie Mae approved direct lender.
Okay. All right. Well, thanks, Darren.
Thanks, Scott. See you guys. I'll talk to you guys soon.
Okay. So who's going to be left with us here?
Nick and Asura.
Okay. Oh, wow. All right. Great. All right. Nick and Asura.
Thanks. Bye-bye.
Thank you. All right. How about AJ? Is he part of oh, that must be Asura. All right. So knowledge, mortgage broker, right? You guys are a direct lender, which means you're Fannie Mae approved. What does that mean? We fund the loans in our own name, and then we can sell those loans to the secondary market. Whereas a broker is an intermediary, right? A broker originates a loan and then decides who they're going to send that loan to for underwriting and closing, right? So there's a few different slight differences between a broker and a lender. Pretty simple, right? Type of loans where RESPA is applicable. Everything in our world, guys, you understand, is 1 to 4 units, right? 1 to 4 units, condos, townhomes, residential lending. I have a client, a good friend, a friend of ours. My girlfriend used to work with this guy. He hits me up last night. He wants to make an offer on this $1.2 million residential rental property. And I'm like, right on. And guess what? It's 6 units. Does 6 units fit into my world as a mortgage broker, mortgage lender? And the answer is no. 1 to 4, right? We do 1 to 4. That's everything is considered residential up to 4 residential units. More than that, it's commercial. Different world, doesn't fit into Fannie, Freddie, FHA, VA, none of that. All right. So 1 to 4 units, residential, permanent for that stuff. So I kind of touched on settlement services. Required disclosure for an originator who is also a real estate broker. You have to disclose that if you're acting as a broker and a realtor in the same transaction. It's allowed under federal law. Some states have some rules against it, but you would have to disclose that you are also a lender, but you cannot require that they use you as the lender. Right? So that's the one thing there. Required bona fide discount points application during a mortgage loan origination. So in today's world, interest rates are much higher than they have been for quite some time. So what people are asking and wanting is how I get my rate down. How do I get a lower rate? And the answer is we charge points. A bona fide discount point is a fee that allows the client to buy down, to pay a fee up front to get a lower rate over the life of the loan, right? So today's market, let's say I could do a loan at 6 3/4 with no points or origination fee. And I needed either to get them lower rate to keep their debt ratio intact, or I need to, or they just want a lower rate. I could charge them discount points. And bona fide means they actually pay a fee paid to lower the rate. There was a day we got paid many years ago a lot differently, and we would charge a discount point to enhance our commission. It wasn't a bona fide discount points. They didn't get a lower rate. We made more money. In today's world, that's absolutely not part of the deal. So a bona fide discount point is a fee paid in advance to obtain a lower rate, right? We understand that. Required information that must be included on an application, Regulation X, right? That is the big amount of just the standard documentation. We're going to go into loan origination activity later, and that's going to be more about the loan application. There's a lot of, and that's good news, is there's a lot of overlap between some of these regulations. So we're going to talk about the 6 items required before it's called a complete loan app under the TRID rule. And that's more important than what RESPA defines it as. Knowledge, we have to let people know who the third-party settlement service companies are and what the fee is going to be for them. Again, we get into the TRID. Initial escrow statement. One of the big things that RESPA also covers is the servicing of a loan. They're servicing a loan, right? You guys understand that there's all these different components to the mortgage. As a company, you guys are a direct lender, and we're going to underwrite and we're going to fund that loan ourselves. Now, the loan, which is a commodity, we typically, as mortgage lenders, mortgage bankers, as we call ourselves, we bundle those loans in groups and we sell them to the secondary market. Let's say we're direct with Fannie Mae. We're selling everything to Fannie Mae, right? So we're going to securitize. That's what we call that, securitization of the millions of loans, that hundreds of millions of loans that we do every year. We're going to sell those to different investors, Fannie Mae. Well, that's the loan itself. What do we do about the servicing? And the servicing is the cream on the top of a mortgage. All mortgage lenders are mostly in the lending business because of the value of servicing, right? Who collects the payment? If we collect that payment every month, we get a little piece off the top. Now we can elect to be a servicer and service that loan and get a nickel every month when they make their payments, or we can sell the value of that servicing to another entity to service that loan, and we get money right now. It's like winning the lottery, right? You can win the lottery, which is a big life goal of mine. I never buy tickets, but I find there's going to be a way, right? 100 million, you can get the big chunk up front, or you can get an annuitous income for 30 years. But if you take it over up front, you're not going to get 100 million, you're going to get 58 million. And that's the same with the value of servicing. So when we get into servicing, we have to let them know if we intend to service the loan or not. And if we do transfer the servicing, then there's certain regulations we have to follow to make sure our clients always know who they're supposed to pay, how much they're supposed to pay them, and getting the information that they need. Part of what servicing does is they collect and hold the escrow account, right? You guys understand escrow, where we've adding taxes and insurance and possibly mortgage insurance, right? We're taking 1/12 of that. Well, that's completely a separate issue from the actual mortgage payment. We collect it all at once, but how we treat the payment and how we treat the escrows are completely different items according to RESPA, right? So we have to make sure that after closing, we've got 60 days to send them an initial escrow account statement showing how much money we collected in addition to their closing cost, usually maybe 3 months of insurance and 2 to 6 months of taxes, depending on what time it is of the year. We collect additional monies up front at closing to fund that escrow account. So when the escrows are due next year, the taxes are due in maybe April and October. They're different everywhere. So when it comes April and we just close that loan today in February, our first payment's not going to be till April. So that client's going to pay a huge amount of escrows up front into their account so we can pay their taxes that are due in April, and next February their insurance is going to be due. So we want to make sure we have enough money in that. So they've got 60 days after closing to get that initial escrow account statement sent out to the client to account for the amount of money we collected on their behalf to hold for their taxes, insurance, and mortgage insurance. And then every year, there's also another annual escrow account statement that they must get and that must be accurate. All right. So settlement service providers, escrow statements, HUD-1 in good faith. Again, it's a little confusing because when you read through RESPA and it's talking about a HUD-1, that's a settlement or closing statement, and the good faith estimate, those are forms that you guys may never use. If all you're doing is first mortgage, residential lending, and you're not doing, if you do a HELOC, you guys have home equity line of credits. If you do a HELOC, you're going to send out a good faith estimate and it's going to close on a HUD-1. Every other loan that you guys do, unless you do construction lending, which is a temporary loan, is going to be done on the TRID forms, the LE and the CD. And that is the majority of all mortgage lenders. That's where we spend our time, and that's where we'll spend our time today. So good faith estimate is an old rule for HELOCs, land loans, construction loans, things that aren't temporary or open-ended, right? The difference between an open-ended line of credit and a closed-end line. Open-ended credit is a credit card or a HELOC. You have a $10,000 limit. You can use it again and again. When you get a $400,000 mortgage, it's closed. Here's your $400,000. Here's your payment. You can't come back to us for more money on that loan. So anything that's open-ended or temporary, like a construction loan or a land loan, it's not a residential loan, it's a piece of dirt. Those are all done old school good faith estimates. All right. So that's the main aspects of RESPA Regulation X that we wanted to touch on today. Anybody got any questions? I can't see the other people. I can only, that's cool. We've got lettuce. We've got Natalie, AJ, and Nick. All right, guys. Everybody doing all right there?
So Scott, for the
Go ahead.
loan estimate, you got to get it out within 3 days. And then
It's still the same timing, 3 days. Oh, great question. 3 days after application, you have to give, place in the mail, or hand deliver to them. Now, when we say 3 days, it's almost always 3 business days, right? And that's just like, I've seen thousands of test questions or practice test questions, and it seems to me that maybe that's a question you want to make sure when you're looking for an answer. It could say 3 days after application, or it could say 3 business days application. And to me, I'd put that 3 days as answer B, and the real answer is C or D, because, oh, B's the answer. I'm going to click 3 business days. And what's a business day, right? Anything not Sunday or a federal holiday, which the most recent federal holiday that was issued in a bulletin a year ago is they added Juneteenth to the list of federal holidays, right? We got President's Day coming up. So next Monday would not count in my 3 days if I took a loan out this week to get out my disclosures, either for closing or for a rescission day, or for the number of days we're supposed to have it before. We wouldn't, this week, we don't count Saturday. We don't count Sunday. Always Saturday is a day, but we don't count Sunday, and we wouldn't count Monday because it's what? It's a federal holiday. So that's where that term business days is so important to make sure. If it says 3 days, make sure there's not an answer that says 3 business days, right? Because the correct answer is definitely business days. Okay. All right.
And then the closing disclosure, you got to get that out for
Closing disclosure is 3 business days prior to consummation. Whatever day they're going to sign those loan docs, they've got to have that CD 3 business days prior to that. We're going to go through that in TRID because it's like, well, there's a 3-7 day. There's a couple little other caveats to that. And when we get to TRID, the TILA RESPA integrated disclosure rule with the LE and CD, we'll look at some different little timing aspects that we need to know for that. Okay. All right. So the next federal regulation that is one of the top 3 federal regulations that you need to be prepared for is Equal Credit Opportunity Act, what we call ECOA, right? ECOA is the oldest. Now, this is also a 1974 rule. So it's kind of interesting. There's big time for changes in federal regulations in the late 60s and early 70s. There's a number of regulations that were born in that era, and ECOA and RESPA were both born in 1974. It's another one I want you to know that ECOA is Reg B, and it's all about fair lending. So be fair. Be fair to everyone, no matter what their race, color, legend, sex, marital status, et cetera, is. That's Reg B, Equal Credit Opportunity Act. So that's why I love knowing the acronyms, but more importantly, what does that acronym stands for? Like ECOA and RESPA and TILA. When you say Equal Credit Opportunity Act, it really helps define, oh, that's the one about the credit and no discrimination. It's an anti-discrimination rule. So it's easier to, when you're looking for an ECOA answer and it's about being fair, Reg B, that's going to help you narrow it down. So what are the factors that we can't discriminate on? Race, color, religion, sex, marital status, age, the fact that you get public assistance, right? I got a pre-qualification. I was a young dude. I was in California way back in the, could have been, I'm not going to say it out loud, but let's just say it was in another century. And the woman was on, and I forget the analogy she used, but it turned out to be public assistance, right? She got a check every month from the government. And in my mind, we couldn't do that. We didn't have licensing. We didn't have pre-licensing training back then. And in my mind, you're getting that kind of assistance. You can't get a loan. I remember telling my boss about it. And she goes, well, what happened? It's like, well, I told her we couldn't help her. She goes, oh my God, you can't say that. You have to call her back. And I did. So whether you're pregnant or not, whether you're getting public assistance, AFDC is what it was called in California, Aids for Dependent Children, you know, hey, as long as she's been getting it for 2 years and there's nothing that says it's not going to continue, no matter what kind of income it is for public assistance, that's a big one we can't discriminate on. But race, color, religion, sex, marital status, age, right? We also know that under marital status, they've added pregnancy. We've changed so much in the last 20, 30 years of what we deal with if a woman's pregnant. If a woman was pregnant and went out on maternity leave years ago, we had to wait. We said, you have to come back to work and prove you're back to work before we'll use your income. In today's world, you cannot ask about that maternity leave. As long as they're still employed, we cannot discriminate based on the fact that they're having babies, you're going to have a baby. And those are the main protected classes under ECOA. All right. A big thing with ECOA besides anti-discrimination is how do you treat people once they apply for credit? Before ECOA, there were no guidelines that said you've got X amount of days to approve or deny or tell the people why the loan's denied. You didn't even have to tell people why their loan was denied. So action taken is, did you approve that loan? Did you actually, is it, in our world, we don't always can't approve the loan right away. It's kind of approved, but then we get conditions. We need more information, right? But we've got 30 days from the date of application to let the borrowers know the status of their loan. It's got to be approved or denied, or we need more information. All right. So no matter what the situation is, if we've got a loan that's been sitting for more than 30 days and it hasn't been approved yet, we either have to deny it or we have to let them know it's not denied, but we need more information. And here's the information we need to maintain our compliance under ECOA, right? So it's always letting the borrower know the status of their credit. And ECOA is not a mortgage law. It's a credit law. It covers all forms of credit, all right? So all forms of credit. General permissible acts under ECOA. That's okay. Circumstances when it's acceptable to deny a credit or a loan, right? There are a lot of reasons to deny credit. And the number one reason is your credit's not good enough. Number two in our world is your income isn't enough to cover your obligations, our debt ratios. We'll get into those today and we'll do some debt ratios. Your debt ratios aren't right. You don't have the assets to put down. But no matter what it is, when you send out a denial, it has to give the pertinent reasons and the fact that the loan is being denied. And that's called adverse action. So we don't say that your loan has been denied when we send them a notice. We say there's been adverse action. The action you wanted was you applied for a loan, and we're going to give you information that's adverse to that. We're not going to give you a loan because of these reasons. And it has to definitely say adverse action when we send that out. That's the key words that we use for turning a loan down. Adverse actions. They added the appraisal rule up until 2012, I think it was. If a borrower asked for a copy of the appraisal, we could give it to them, but we didn't have to. and it's interesting that this is under the ECOA rule, but this is where our appraisal rule comes from. When we do a loan and we get the appraisal, what's the rule? What do we have to do with it? Can one of you guys help me with that? Right? We have to give them a copy 3 days before consummation or when we receive the appraisal, and we have to send them a copy of that appraisal. Now, we can waive the 3-day waiting period because sometimes maybe we get the final appraisal underwritten and it's not quite and it's less than 3 days before we want to close. So most lenders send out the appraisal waiver. They can't waive the fact that we have to give them the appraisal. They can waive the fact that they're supposed to have it within a specified time 3 days before closing. So if there any reason things are delayed, typically it's part of our, I find it odd, but our industry sends that as part of their upfront disclosures to waive the timing of receiving that appraisal. But upon completion, or within 3 business days of consummation is when we need to get them a copy of that appraisal. If the loan doesn't close, we've got 30 days to send them a copy of that appraisal. Okay. So even if the loan doesn't close, they still have to get a copy of the appraisal. So that's became a regulations about a decade ago, and it's a provision of Regulation B. All right. Prohibited factors. That's the same as saying the protected class. These are the factors we're prohibited from considering in their loan application: their race, color, religion, sex, marital status, age, the fact that they have or do receive public assistance or have filed for any protection under the Consumer Credit Protection Act, the CCPA. I haven't seen anything with CCPA on it for years. I see it a long time ago, but that's just protected, right? So we're prohibited from making decisions or even in credit, except in the mortgage business. Is there any other credit you apply for where they ask you to give them your race, ethnicity, and gender and age, right? Those are prohibited factors. If you apply for a credit card, if you apply for a car loan, they're never going to ask those. And we don't ask for those things because of ECOA. What's the regulation where we ask the borrowers to voluntarily provide us their ethnicity, their race, and their gender? Anybody know what that's called? Which one? It's HMDA. We'll get to it later. So ECOA, you can't ever ask race, color, religion, sex, marital status, age, unless you're a mortgage industry. Then we're going to come up with this new law later in life that says for home mortgage disclosure, so we can monitor who's applying, who's getting turned down, and what's going on in the world of mortgages. We're going to ask every loan applicant to provide their race, ethnicity, and gender. And we also ask their date of birth. All right. So those are 4 prohibited factors that we ask. Now, understand that when we get that HMDA data, it's to report to the federal government, and that's where a lot of data and statistics come from, but it is never in any way part of our underwriting process. It's truly a reporting thing. It doesn't have anything to do with when we run the loan through DU or LP or even get it underwritten. Not a factor, but we have to ask that. So ECOA says you can never ask in the application of credit, and there's that caveat: mortgage, you're going to ask things that nobody else could ever ask on an application. It's just part of our application, right? Required disclosures when an application is denied. Well, I already went over that. Marital status. So on the loan application, and we're going to go through the loan application today. I'm going to put it up on the screen and make sure we go through it and understand it, because it's one of those things that they could ask you a question about what's on the loan app, or what's on the closing disclosure, or what's on the loan estimate. So we want to go through those. I want to show you where you can find these to refresh yourself. Maybe it's one of the things you want to do that you're not feeling comfortable about the day or two before you go in. So I'm going to show you where I get all this stuff. It's pretty much, internet's made this pretty easy to find stuff, right? So adverse acceptable terms to describe marital status. So you're either married, unmarried, or an unmarried is single, divorced, and widowed, right? So there's not a divorce section. There's not a single section. It's either married or unmarried is the term that we use in our world. Adverse action. Notice including multiple applicants are on the loan. You have to let everybody know that the loan is denied. So there's sometimes you can't do the loan because of there's two borrowers and one borrower is just fine, but the other borrower, their work history is just too choppy. They've had big gaps. They've changed jobs 5 times. They're not in the same line of work. The loan's denied. We don't just deny that borrower. So it's like once you're on an application with somebody else, the adverse action goes to everyone and it includes everyone. It's not something that's reported on somebody's credit report. It'll show that you had an inquiry, but there's no loan was denied in your credit rating or anything like that. Definition of elderly. There are some rules about elderly and credit. And just remember the definition of elderly. Anybody know the earliest age at which somebody can start collecting Social Security? How early can you start taking it? Anybody? You guys are too young. I'm counting down the days. No, it's the answer 62. So in ECOA, elderly is 62 or more. Right? There's not a lot to do with that, but that's just a term. Disparate treatment scenarios. Disparate or disparate treatment. What does that mean? That means you are violating ECOA based on the prohibited factors, race, color, religion, sex, marital status, age, but it's not something that you overtly did. It's something in the way that you did something else that said, well, you're not really trying to be inclusive. So right now, I do a lot of continuing education. I go to different compliance conventions every year, and I'm active in the mortgage business in many ways. Not that many ways, but a lot, it seems like. And one thing, when we get discrimination cases that are out there, it's very rarely did they say, we aren't going to do loans for these folks. What they do is, we're really going to try to do loans for these folks and really not pay attention to that. There's this big case out of Memphis, a big bank, and I was in the South. I was in Alabama last year, and I ended up in this bank. It's called Trustmark. I'm like, oh my God, this is who's this big case is being going on right now about their discrimination. So they're based in Memphis, and Memphis is a city that has a high percentage of African Americans, and they had no African American loan office branches in African American neighborhoods. They had no African American loan originators, but they did a few loans for African Americans. If you went in and you applied and you qualified, you'd get a loan. But they went out of their way not to serve that market. So they weren't discriminating by how they treated loans and turned people down. What they did was, it's disparate treatment, is you focused on the higher end, the nicer part of town where mostly not the people of color did not live. So by disparate treatment, right? You don't discriminate if they apply. You just didn't try to get that entire 50% of your marketplace to apply. So that's an example of disparate treatment. It's not like, oh, we're not going to take your loan application because you're whatever. It's like, oh, let's just keep focusing on who we're focusing on. We're happy doing business in that marketplace. So that's an example of disparate treatment. I didn't discriminate if I got a loan from a minority, but I sure didn't try very hard or didn't advertise or do the things it took to be inclusive for all those folks. So that's the disparate treatment definition of how it works. We can't require a cosigner, right, under ECOA. Why, anybody in 1974, why do you think that's part of the rule? Require a cosigner. You guys know in like 1970, if you were a woman and you wanted to buy a car, you think a bank would give a woman a car loan on her own? No, we need you to get a man to sign for you. Literally, this is the way it was. So that not requiring a cosigner means you can't ask somebody because of their age or gender or any of those other factors to get a cosigner for you just because we don't like to give loans to women. Now a woman can go get her own car loan or get her own credit card, but that wasn't always the case. In 1974 was a big time with women's liberation and women's rights. So that's like one of the main reasons why something like that would be included in ECOA. Now, we don't require a cosigner, but can we ask a borrower that doesn't qualify on their own I've done it before. It's like, it's just not working. Your dad said he would help with the down payment. Would your dad be willing to cosign for you to help you buy the house? So I don't require a cosigner, but a cosigner is needed for them to qualify. See, there's the difference there, right? So requiring a cosigner, I don't want to give you a loan by yourself. You qualify, but that's silly. We wouldn't do that in 1965. versus you can get a cosigner, might be the only way that you can get the home because you don't qualify on your own. Different scenario there. Factors considering credit worthiness. We'll get into credit later. Credit worthiness is, it's all credit score now. When ECOA was written, there was no credit scores. So things were a lot different. And now in today's world, credit score basically it's just that simple. Types of acceptable income. I already gave you that example. If you're on public assistance, right? If you're on maternity leave, we need to use that income. In fact, maternity leave, if you're still employed and you're out on maternity leave, we're going to give you credit for whatever your income is, right? And that's the main changes there. And the other ones with people that are on public assistance or sources of income. We'll go through sources of income later today that aren't ECOA driven, but those are the only two in the race, color, religion, sex, marital status, age that have to do with ECOA. Information or kind of loan application, right? Time frame, sending an adverse action. We got 30 days. There's a lot of duplicates in the review here, but that's fine. Actions of originators should take when a borrower refuses to provide ethnicity, race, or gender information. You guys, what do we do if they elect not to give us their race, ethnicity, and gender? Well, if it's face-to-face, we have to look at them and we make our own observation as to what race, ethnicity, and gender they are. But in today's world, face-to-face applications are rare. So if they choose, I wish not to disclose, that's it, because we didn't see them. If you do a Zoom application or you do a face-to-face, they've added that. Then you have to, all right, if you don't, when I did loans early in my career, we always did face-to-face applications. And I would explain why we got HMDA for monitoring purposes. And if you don't check the appropriate box, or if you don't want to disclose, that's fine. But because I'm sitting here today, I'm going to have to make my own determination as to what race, gender, and ethnicity you are. So you might as well go ahead and check what you want to be checked, so I don't have to make a wrong decision for you. But if it's not a visual and they don't provide it, they don't provide it. Okay. What's our time frame here? Oh, 8 o'clock. All right, let's take a 10-minute break. All right, we'll see you back in 10 minutes. That's why. I got one guy in the class. Hey, Michael. Hey, do you want to mute? Oh, I didn't do that. All right. We are back. Let me know when you guys are back.
I'm back. I'm here.
All right.
And my name is Ashra.
Ashura?
Hmm.
Good. Thanks. How are you today?
Good. How are you doing?
I'm doing good. Hold on. Let me mess with this. My screen is not sharing the way I want it to. Stop share. And if I go screen share. Huh. All right. All right, Ashura. So Ashura and Nick, I think, and then is there, and then Natalie is not a student, I don't think. Okay. All right. So let's pick up where we left off. So those are the main highlights of ECOA. Regulation B, be fair, treat everybody the same when it comes to applications, right? Fair lending, 1974. Don't ask questions that don't have anything to do with income, assets, etc. Race, color, origin, sex, marital status. Really protecting the newest thing that changed with ECOA over the last few years was women on maternity, or if women were pregnant. There were some big lawsuits that happened a handful of years ago. A company I did a lot of training for back in 2015, 2018 had a big fallout because of just asking questions that used to make sense. And now in our world, not defending them, and now they don't make sense. So ECOA, and then RESPA, Real Estate Settlement Procedures Act. It referrals, Regulation B of RESPA. What can you not do? Give anything of value, right? Does a $10 Starbucks gift card violate RESPA? The answer is yeah, it does. In exam world, I've always said, you know, it's like driving 60 in a 55 on a bright, beautiful sunny day, and you're in your own lane doing, you're probably never going to get pulled over. But are you speeding technically? And the answer is yes. So anything to do. Now, promotional, let me just touch on one thing with RESPA that's a little caveat. Could I go in and bring lunch? Let's say I call on a real estate office. I'm a loan officer. I'm trying to get referrals from realtors. And I want to bring lunch to the real estate office. I invite everyone, and I do a little symposium on how to do a 2-1 buy down and get your buyer a lower rate for the first couple years in this market. Would that be a violation of RESPA? And the answer is no. You can add value. You could buy an office lunch as long as everybody was welcome, and then there was a training or an educational situation. But it wouldn't be for the expectation of referrals. If you only invited people that you did business with, I held a Christmas party every year, and if you give me business, you're coming. As long as I invite everybody, then a little bit different deal. Okay, so there's that one little caveat. All right, let's go into TILA, truth in lending. Over here. Why won't it do that? All right, doesn't matter. All right. Truth in lending. And it says right in the name what it's for, right? Truth in lending. Yeah. Not only does it cover what we charge and how we disclose it and how we have to disclose it, but also covers advertising, truth in advertising, right? So Truth in Lending Act, Regulation Z, again, this is the third one that I want you to, that I would feel I would ask you a question according to Reg Z, and I want you to remember, to tell Z truth. Truth in Lending, Reg Z, tells Z truth about everything there is to do with disclosing your cost, how you disclose, and how you advertise. For the most part, that's the big deal. All right. So the first subtopic it shows is a notice of a right to rescind. Okay? Rescission. When can you rescind or cancel a loan that you've already agreed to signing it? What kind of loan do we get a rescission on? Does anyone know that? It's only on a refinance on your primary residence. Okay. If I'm refinancing my house and I live in that house, when I consummate or close my loan, I also get a 3 business day rescission period. We are not going to fund that loan for 3 business days to make sure I don't rescind. So I get 3 days to say, never mind. Now, if it's on any kind of purchase transaction, there are no rescissions on purchases. If I'm refinancing an investment property or my second home, I don't live in it, it's not my primary, there's no rescission. So just think of why did they come up with that? Well, people are being duped. And back in 1968 is when TILA, this is the oldest regulation we have. It's the first consumer protection for lending. And again, it covers all kinds of lending. It just doesn't cover mortgages. It covers credit cards. It covers any consumer lending, not business lending or corporate lending, but anything you or I would go get, car loan, credit card, personal loan, mortgage, it's going to be governed by TILA, Reg Z, right? So rescission says you're refinancing your house. Let's make sure after you sign the documents, you've got a few days to make sure you're doing the right thing for you and you're not, and you can go get it checked out further and somebody's not going to take advantage of that. All right. There is a caveat in TILA that says you can waive the rescission for financial hardship purposes, but it's more rare than rare that a lender would waive a rescission period. There's some times I know some situations people that used to do, they would get people out of foreclosure. And if they were getting ready to go into foreclosure, they would allow the rescission period so people didn't lose their house. But that was back when we did hard money or subprime, right? There's not a loan I know of today that I'm sure there's private money out there that would get somebody out of foreclosure. But you can waive rescission with a financial hardship, but it's rare than rare. So that's the only loan that gets a rescission is what? Owner-occupied refinance, 3 business days. And once you guys start doing loans, the good news about coming into the market with rates high is that every loan you might do is, we hope in the next couple of years, we're going to be able to do another loan for them and get them out of the 6s and into the 5s or the 4s. Just because history says, pundits say, when rates go up, they will come down, right? Now it's kind of funny. When I got out of the industry in 2007, we were in this market right now, about 6.5%. And I actually used the words to people, it's the lowest interest rates I've ever offered. I had never offered a loan under 6%, under the 6s when I got out of the industry in 2007. I've been doing it for a long time. It just didn't exist. Well, now with price points where they are and everything else, we've backed ourselves into a corner as far as the Fed, as how much you can manipulate interest rates without killing the housing market. So not a lot of refinances out there because of where rates are. I've got a refinance right now I'm working on because the guy needs some money to go into to build this business that he really wants to build. And this house is free and clear, and I can get him a few $100,000 pretty, and it's the cheapest money he can get, right? Getting a 6.5% rate. That's high compared to what? It's not compared to anything else in the market. So refinances, RESPA, rescission. Permissible fees and finance charges. Basically, we'll get into the permissible fees and finance charge and the terminology that we use here, right? Advertising requirements. Basically, when you read through the truth in lending section in your text, it talks about trigger terms, right? If you, do you guys recall that? If you say $500 a month, you buy a house from as little as $1,000 a month, that's saying $1,000 a month triggers how many months, and what's the number one thing that's most important if you're dealing anything at all with rates or payments? We have to disclose the APR, right? APR, annual percentage rate. So if it has a trigger term, it's the amount or any percentage of down payment. If we say low down payment, all right, well, then we have to tell them as low as down payments is 5% with a 6.94 APR. If we talk about payment, a down payment, or how long, And if we use the word fixed, fixed for how long? So those are the main terms in advertisements that govern mortgages. And the number one, fix it, APR, right? Not the interest rate, not the finance charge. Those are never required on ads. If you're getting into anything about rate or payment, APR, okay? Advertisement requirements, knowledge of the core concepts of TILA. So 1968, people are borrowing money, and they're not really, the layman doesn't understand what that cost of credit is. Truth in lending is mainly about the cost of credit. And that's where they came up with these specific terms, APR, finance charge, that we have to disclose to people so they understand what this credit is costing them, right? I could give you a mortgage at 6% today, right? Could I not give you 6%? But what are you going to have to do to get 6%? You're going to have to pay what? Discount points, right? So what's a better deal? 6% with 2 discount points, or 6.75% with no discount points, right? So people would think, because the 6%, let's say we're doing a $300,000 loan, that's $6,000 in discount points. So we've got to take that 6% plus the $6,000, add it into the interest rate to calculate the actual APR. Whereas if you're quoting 6.75 and no points, your APR is going to be much closer to what your rent interest rate is versus that. So that's the whole point of APR, is to know the cost of credit so you can compare different offers. Oh, they've got a lower interest rate. Yeah, but their fees are twice as much, which means their APR is much higher. So the cost of credit is what APR determines. All right. So they use the term finance charge. What we do is we take all the finance charges, add it into the total interest as if it were interest, and that recalculates the APR. One thing I'm going to tell you guys, you never have to calculate APR. Right? On the exam, they will give you a simple calculator. They're not giving you a HP12C financial calculator that you can use to calculate all these different. You don't need to do that. And now our operating system, I carried this special calculator. It's called a financial calculator, HP12C, for 20 years. I can't even remember how to use one now. Why? Because everything I put into my loan operating system does it for me, right? So you won't have to calculate. You just need to understand where it comes from. So what is a finance charge, right? If I'm giving you a mortgage, a finance charge is anything, my concept on this is anything that a buyer paying cash for the house would never pay is part of the finance charge, right? Loan origination fee, is that part of the finance charge? Would a cash buyer pay a loan origination fee? They're not getting a loan, so they're not going to pay an origination fee, right? So that's finance charge. So we're going to add that on top of the interest rate to go calculate the APR. An underwriting fee, a processing fee, anything related to you getting a loan is how we calculate. It's called a finance charge, and it makes your APR more, right? So so think that. So when you have a situation, would this be a finance charge? Which are the finance charges in the following situation? So when you're looking at that type of question, you're going to say, all right, if I was paying cash for this house, what would I never pay? Appraisal is the one exception. An appraisal is not part of the finance charge, because I've had a few people that I've been referred to or call me. It's like, I got a client, a realtor, I got a client paying cash for this house, and they really want to get an appraisal. You think it makes sense if you're paying cash for a property that you might want to get an appraisal before you'd pay cash for it? Might be a good idea, right? So just know that of that one rule, something that it's part of the loan, an appraisal is not part of the finance charge. But anything else somebody's paying because they're getting a mortgage, underwriting fee, discount points, loan origination fee, application fee, processing fee, those are all part of the finance charge. So finance charge, what's the question you're going to ask yourself? Would a cash buyer pay these fees? The finance charges are added to the interest. We're going to take my $3,800 in finance charge on top of my 6.5% in interest, and we're going to do this secret calculation that gives you APR, your annual percentage rate. Okay, everybody, you guys understand the APR. And if you're doing any kind of advertising or speaking to a client, by law, if I tell a client, well, basically we're looking at a 6.5% rate today, I'm supposed to then calculate and give them the APR, even if I verbally give them an interest rate. Is that done all the time in our industry? Probably not. But is it part of the exam world where that's what you're supposed to do? It is, okay? Total points and threshold. We'll get into that with QM though. So define the finance charge and an APR. Loans covered under TILA, consumer credit. I touched on that, right? When you apply for a credit card, it tells you what the APR is. It tells you what your finance charges are, right? When you get your statements on any kind of consumer loan, it gives you those information. So this is a consumer financial protection law is what it was originally called. And we call it Regulation Z, Truth in Lending. Permissible APR tolerances. So does the rate ever change between the application and closing? And the answer is, yeah, it does. A lot of times we take an application and we don't lock the loan in, which means when we lock it in, if it's different at all, the APR is going to be different. So we have to recalculate and redisclose that APR anytime there's a change that's affected by it. And we'll see in TRID that you have to send them they have to get a new closing disclosure if the APR changes by more than 1/8%. So what's the tolerance for APR under TRID, until 1/8%. Business day, we talked about that. And again, it's just like when we got into RESPA, when we're doing mortgages, a dwelling is a domicile that is used for residential purposes, 1 to 4 units. That's our little niche, everything we do. Residential mortgage loan is a dwelling and we did business day. Seller contributions. We'll see a place on that on the closing disclosure. So last year, I live in Denver, and I spent a lot of time up in the Vail and Eagle County, which is where I first lived in the Vail Valley when I moved here. So I have a lot of clients and friends up there. I do a lot of business up there as well. And in these markets that we've had last year, 2 years ago, people were paying over appraised value, and they were paying the seller's title insurance just to get the house, because we've got a real problem with inventory, right? Not enough houses for sale. Well, now that the market's changed and things have slowed down considerably, sellers are willing to pay seller contributions on the buyer's behalf, right? So when a seller pays something that is standard a buyer fee, we call that a seller contribution. And all the different loan programs that we're going to see later today, FHA, VA, Fannie, Freddie, they have limits on how much the seller can pay in contributions. But it's something that is standard paid by the buyer that the seller has agreed to pay at closing as our seller contributions. And they're allowable. Cash isn't allowable. We don't allow cash back over 1%, but they can pay all their closing costs. They can pay all the discount points. They can pay it to buy the rate down. They can pay all their closing costs up to a certain percentage depending on the loan amount. And I already talked about the refinancing with rescission on what? An owner-occupied refinance, not a purchase, all of those. What about if I'm getting a HELOC? I live in this house. I don't want to refinance because we've got a 2.75 mortgage, but we need, 50 grand to do some home improvements. If I took a home equity line of credit out, do you think that would be a loan that required a rescission? And the answer is yes. When you do a loan, it's either a purchase or a refi. So remember, if that loan is not being used to purchase the home's already owned, it's considered a refinance. Well, it's not a refinance because I don't owe anything on my house. Are you purchasing it? No, I already own it. I just don't have a mortgage. Then it's considered a refi, okay? That's how you delineate between those two things. Refinancing. So, all right. Two of subsections under TILA are these High Homeownership Equity Protection Act, HOPA. And HOPA is what would have been at one time, it's called a high cost loan, right? The thresholds is in our world, there's something called the APOR, the average prime offered rate. You guys remember this from your 20-hour class, right? So if today's rate, if you look at all the FHA, VA, Fannie, Freddie kind of loans, and the average prime offered rate is 6.75, a HOPA loan has to be 6.5% higher than that. And I don't know any loans out there that are going at 13.5%. But if there was, back then you would have to classify them as a high cost loan, right? And it's got a slight different rules. They have to go to counseling, and there can't be a prepayment penalty, et cetera, et cetera. So the main thing you need to know, HOPA, high cost loans, 6.5 on a first, 8.5 on a second, and they have to go to counseling. And then there's different rules regarding the loan. So there's just a subsection that you guys can quickly take a look at under that. The one that does come up a little more often is, especially on smaller loan amounts, is the higher price mortgage loan. This is a loan that's only 1.5% more than a average prime offered rate, right? It's higher priced. So there are some loans today where we're doing bank statement loans, right? Instead of a self-employed borrower giving me tax returns, their tax returns don't show their true income. So they can give me 12 months bank statements. Well, that rate's going to be probably more than 1.5 over a conforming loan. So those loans get into higher price. So a higher price mortgage loan, what they call an HPML, is only 1.5% more than the average prime offered rate. And the only little caveats are you have to have a full appraisal. No drive-bys, no waivers, no interior waivers, which don't really happen on these kind of loans, but you have to have a full inspection of the interior and exterior on the appraisal, and the borrower must have an escrow account, right? It's a strange situation, but that's the rules with higher price mortgage. Excuse me. All right, we'll get into comp later, LO comp rule. All right, and then the second part, the most important part, well, I'm going to say not most important part, the new annexation of Truth in Lending Reg Z is TRID. And TRID is the TILA RESPA integrated disclosures, right? So back when first part of my career and the second part of my career, just not this part, we did a good faith estimate. And everybody had a different good faith estimate. There were no rules of what actually had to be on the good faith estimate. You just had RESPA says you have to give them a good faith estimate of the settlement cost on the loan. That was it. And I had to say, I used to have to get people all the time that would get a GFE from another lender. That was complete BS. There were no rules as far as what's ramifications. If I underquoted fees, if I underquoted my interest rate, you could lie all you wanted on a GFE, but you had to give them one. Well, what's the new LE say? Everyone uses the exact same form in the exact same way, using the exact same terms. It's all the same. And we have strict tolerances, right? We're going to go through tolerances of how much we can be off, if any, on the new LE and CD. So that's what there's the good faith and the HUD-1, which is used on just a few transactions, and they integrated that into Truth in Lending, and now we're using APR and using all these other aspects of what the LE has to have on it. All right. So we'll get to the copy of that right here. I'm going to hit a couple of the other one. So you guys learned about some of the disclosures that the loan estimate has to go out in 3 days. There's one major, disclosure that has its own timing, and that's the affiliated business arrangement disclosure, right? You guys, I worked for a company in California years ago, Mission Hills Mortgage, and Mission Hills Mortgage was owned by Tarkon Financial. Tarkon owned Mission Hills Mortgage. They own this we're in Orange County in that area. They own Tarbell Realtors. They own a big real estate company. They owned a mortgage company. They had their own title company, Landwood Title, and they had Tarbell Insurance Services, right? So anytime I did a loan for an agent from Tarbell Realtors, we had to let the people know that Mission Hills was an affiliated business arrangement. We had some form of common ownership, and that you don't have to use the common ownership, which a lot of the Tarbell agents took to heart. I mean, I did a lot of business for a lot of other agents, but I had a couple of, in my region, we definitely created some great relationships with a few real estate offices and had horrible relationships with others for whatever reason. So we didn't get all their business, but we had an in. But if we did loans for them, we had to disclose what? The affiliation between the businesses. The number one thing I want you to know is you cannot make them use an affiliated source. You can't make them use your mortgage company. You can't make them use your title company. And the disclosure is due immediately upon referral. All right. So if my agent says, I want you to talk to Scott over at Mission Hills, and by the way, they're an affiliate, you know, they work for a company that we have ownership interest in, but that's not why I'm sending you to Scott. You know, I'd help my agents know how to refer me to make people think it wasn't just because we're in-house and they weren't getting any money. So the real estate agent's not getting money. But when is the disclosure due? The answer in the exam world is at the time of referral. Not today, not tomorrow, not 3 days. ABA disclosure at the time of referral. Make a note of that because it's the only one that's unique that way. Everything else basically is 3 days before or after application or 3 days before consummation at the time of referral. All right. And the borrower information included under Reg Z. So Reg Z created these new financial terms: APR, finance charge, total of amount financed, which we really don't use anymore, but it is on the CD, and we'll go through that. So those are the new terms that were coined and that were always required under Reg Z. So before TRID, I gave them a good faith estimate, and then we sent them a Reg Z disclosure, which gave them their APR and their finance charge. Separate form. Now integrated. That's why. Timing, disclosures, circumstance, when a loan estimate may be amended. Let's talk about when a loan estimate is required. When is a loan estimate required? Within 3 days after receipt of a complete loan app. You guys know what the complete loan app, 6 items. What are they? Do you recall, AJ or Nick? So, write down aliens. A-L-I-E-N-S, aliens. When you have your aliens, address of the property, A. Loan amount, income from the borrower, estimated value of the property, their name, and their social security number. Those are the 6 key items under TRID that trigger the loan estimate, right? Now, ECOA is different. ECOA doesn't use aliens. ECOA says if they've asked you information and you've talked to them about credit, blah, 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 they have a little different of what a loan app is. But the most important thing you need to know is under TRID, when a loan estimate is required is within 3 days after you get aliens. So, you know, the last couple of years, I had a lot of buyers that didn't have a house yet. And they wanted to know, well, if I find a house in the high price point, let's use $600,000. If I find a property in that, and my answer in Denver, good luck. But yeah, if you find something for $600,000, what's my cost going to be? But they haven't found a house yet. Can I provide them with a loan estimate while they're out shopping for a house? I cannot, because a loan estimate is only allowable when we have a complete loan app and we don't have an address of a property. We know they're looking at the $600,000 price point. That's an estimated value, but I don't have an address. So can I do a good faith estimate for them? Or any other, I use a program called Mortgage Coach, which I can show you all these different cost and everything. I can give them that, but it's not an official loan estimate. Official loan estimate can only be issued when you have an actual loan, which is address, loan amount, income, estimated value, name, social security number. Okay. So I can give a GFE, I can give them a closing cost worksheet. I can use my mortgage coach presentation to compare different loan products, different down payments for them, but I cannot give them an LE. But as soon as I get that, as soon as they call me and say, Scott, we got a property, and I get a copy of that contract, now I have an address. Now my 3-day clock is ticking because I've already had their name, their social, I pulled their credit, I've got their income, I've got everything else, right? So that's when you can use an LE and when it's required, and the difference between a complete loan app under TRID, got to have those 6 items, and you'll never forget them now because you know they're aliens. All right, which loan estimate may be amended. So I gave them a loan estimate. Can I just change my fees on that later on? I can't. There's certain things I can't change unless we have a what we call a change of circumstance. A change of circumstance, right? Well, I can't go in and change my loan fees. You know what? Let's go to the LE right now. I think it's time to do that. All right. All right. So here is a sample loan estimate. We all use the exact same form. There's no difference between lenders and their loan estimates now or their closing disclosure. It's all the same. So if you can see, this is directly from the CFPB, consumerfinance.gov, owning a home loan estimate. What I love about this, as you can see, between the yellow boxes or the pink boxes, if you get in there and you click on it, look what it does over here. It really breaks it down better than anything I've ever seen. Okay, so let's just look at the loan estimate since that's where we are. And I want you to really understand the loan estimate, and I want you to really understand the closing disclosure. I want you to have a good feel for what the loan application looks like too, because those are things that they're going to ask on the form. All right, like they could ask what information is required of the borrower on the LE, of the lender, and we'll show you what that is, because those are things that we could ask. So let's there's your applicants and their current address. You've got the actual property address, because why? Because we can't give them a loan estimate without an address. So if they're shopping for a house, no LE. They get a house, get a contract, then we issue it because now we have the property address, sales price. We got to give them the loan term section. Is it conventional FHA, VA? Is it a fixed rate? And it's a purchase or refinance in the term, right? Loan ID number, and then rate lock. The rate is locked and the rate is not locked. And that varies depending on the loan officer and the type of client you're dealing with. I know some loan officers who love locking the loan in right up front. Some people, have a better feel that the market's a little oversold right now. I think it's going to get better. Or some borrowers think interest rates are going to get better in the next month, so they want to hold off on locking in. But if we don't have a loan lock, it says no. Number one change of circumstances of why we always send out a new LE is I took a loan today, and 2 weeks from now, we lock the loan in. Now I have to send them a new loan estimate, because my interest rate could be different. My origination or discount points could be different. And we're going to also check, yes, the loan is locked until. And the two things that you want to know about the until on this is the date and time with time zone. That's obscure, but that's part of the requirement. So that's like a little trick question I would throw in there if I was doing an exam for you. Date, time, and time zone when that rate expires. All right. And then can this amount increase after closing? And that's no. Loan amount, rate, payment. Prepayment penalty. The answer is no, pretty much across the board on that. It's even a bad example. CFPB has one that says yes, because it's There's a few loans that have it, but they're pretty much maybe they're very rare, very rare. Balloon payment, again, I don't know anybody that's doing balloons. Everybody understand a balloon, what that means? Short-term loan. So when loans were started, I'll give you a 5-year interest for 5 years and then pay me off. And that's what a balloon is. It's done before the 30-year term or the 15-year term. 30 due in 5, balloon. 30-year amortization due in 5. So then we're going to give projected payments. And projected payment includes your estimated escrow, your mortgage insurance, your principal and interest, and then your total monthly payment. Why does their payment go down here years 8 through 30 if it's a fixed rate loan? And that's because the mortgage insurance goes away, which we'll hit that regulation here in a minute, right? Mortgage insurance isn't forever on a conventional loan. It is on FHA, mortgage insurance premium, but on conventional, there's ways to get rid of that. So estimated escrow payment, what's included in your estimated taxes, insurance, and assessments? Property taxes, homeowners, etc. On occasion here, you'll see a homeowners association, which would be, is it in escrow? And the answer is no. I would say other homeowners association. You're buying a condo, or we live in a master community here. We got a $46 a month master HOA over here in Stapleton. That would be shown, yes, there's HOA, but not escrow. You never escrow association dues. You do escrow taxes and insurance when required or when the client wants it. So estimated closing costs and estimated cash to close. But where's all their other closing costs? It's so weird at the bottom of page 1, you're getting a big number without any other numbers up here at all about closing it cost. So that's page 1. Page 2 is, here's your closing costs. We're going to give you the totals up front, but then we're going to break it down on the next page. So one thing I want you guys to make sure you understand on the second page is the tolerance levels of how much we can be off on our loan estimate. The tolerance, origination. So section A, it's what we call, these are our lender fees. Origination, discount, application, underwriting, anything that we as a lender are charging goes there. That's a zero tolerance. You can't charge $1 more over what you disclosed into section A. Zero tolerance, right? Section B is 10% tolerance, right? These are things we require but aren't paid to us. We require title insurance, we require tax monitoring, we require flood zone, we require title insurance, etc. So if that's 10%, if they choose one of the people that we recommended that they use. Like when I do a refinance, borrowers don't ever know. I've never had a borrower want to use any title company. I have no idea, right? So when it comes to a refinance, we always use the company I have a relationship with. But because they're referred by us, I could only have a 10% difference. If they don't choose, or the realtor in a purchase situation doesn't choose the title company that I recommend, then we don't have a tolerance there. But if they do in the section 2, if they choose who we recommend, 10% tolerance. If they don't, no tolerance. In this section, services you can shop for, again, it's if they use our title company that we recommend, but that's also part of the 10% tolerance. The rest of the LE is no tolerance. Like if I say that maybe your homeowner's insurance is going to be $1,500 a year and it's $2,000 a year, that's fine. There's no tolerance for taxes and insurance and all of these other fees. So zero tolerance and no tolerance are completely not the same thing. Understand that, okay? Zero tolerance, can't charge $1 more than what you told him it was going to be. No tolerance means that fee is what it is, no matter what I estimated it to be. I don't have control of it. It can vary, and people can shop for insurance and do what they want to do. And then third section, in 5 years, and there's your APR and the total interest percentage and different things about assumption. that when it comes to questions like this, like about assumption, late payment, servicing, when do we disclose if we're going to service a loan or not? It's on the loan estimate. We will transfer or we're going to service your loan. Most of us, even if we service some of our loans, click transfer because we might transfer it a year from now, 4 years from now, or 3 months from now. So it's a rare situation where we say we're not going to transfer the loan. Because it can always be sold. It's an asset. So that's the LE. It's consumerfinance.gov loan estimate. It's a great, if you don't know about what these things mean, I would click and go through all of it. Really helpful, I feel, in this situation. All right, cool. Okay, the next so that's LE and everything we need to know about there, consummation. And then the CD, we've got one of those for the closing disclosure as well. Same, it's again, consumerfinance.gov, owning a home, closing disclosure versus loan estimate. All right. So those are important things to understand and go through and make yourself read each section and understand the flow of the LE and the CD. Before closing or after closing. So it's the same format and the same cost are called the exact same things. And it's going to say, is this more than your loan estimate said it was? And is this paid? And this, remember, this is a closing disclosure. And it says, is it paid at closing or before closing and by whom? In this situation, the seller, somebody paid for the appraisal fee. I guess the lender, because it's seller paid, borrower paid, or others. So if I paid for the appraisal, I don't know why I do that, but some people do. That would be shown by others or at closing or before closing. So a lot more pages on the CD. So again, I really recommend just reading through it. And if you don't understand what it means, find the pink box and click on it. All right. Ooh, where'd it go? There it is. All right. So that takes us to that. All right. These are all the little tidbits of the other regulations that there are. So notice how big RESPA, ECOA, how much it is, and each one after that, other federal guidelines. HMDA, race, ethnicity, gender, government monitoring purposes. If they don't provide that information and it's a face-to-face where you can see their face, you have to provide it for them. Otherwise, I choose not to provide, and we leave it blank. HMDA, Home Mortgage Disclosure Act. It's how we know that African-American applications are, that a company in this marketplace with a 37% African-American population only did 2% African-American loans. That means they're not doing a very good job. So we might look at them for ECOA violations where it be real or disparate, right? So all those kind of data all comes from HMDA. It's a major amount of stuff we as lenders have to report, but for way more than that. But for exam purposes, that's what you need to know about HMDA. Fair Credit Reporting Act. That's a newer law, and the FACTA is an updated law having to do with credit reporting. You get a copy of your credit report, how to dispute it. You get a free copy of your credit report. So just make sure, you guys have a text and information. So look at the highlights here, the points of emphasis that they show on these. Just make sure you understand that, okay? So another thing you want to know is who oversees the rules, right? So almost everything in our world is CFPB, right? You guys have heard the Consumer Financial Protection Bureau, created because of Dodd-Frank after the great collapse and all of that. But couple rules, a couple things that aren't CFPB, almost, ECOA is, Truth in Lending is, RESPA is, HMDA is. But what you get is fair credit. When you get down here to Federal Trade Commission red flag rule, who do you think oversees the red flag rule, looking for red flags of fraud, et cetera? And that's the FTC, right? CFPB, Bank Secrecy Money Laundering Act. Again, you can't have both 10,000 deposit. If we, number one thing I want you to know about the AML, anti-money laundering, and the BSA is, as a lender, if we feel something is askew with anything to do with the finances in their bank or their assets, we must file a suspicious activity report. So us as a loan originator, we might take that, and maybe the processor sees it, maybe the underwriter sees it, or I've had a couple loans in my life that I thought, there's something not right here. So I had to report it, and then our company has to file a SAR, S-A-R, Suspicious Activity Report. We don't tell the borrowers that we filed a SAR against them. It could be nothing, but that's the number one thing. When you look at the takeaways, make sure you understand SAR, Suspicious Activity Reports, circumstances filing a SAR, privacy requirements. You don't tell anybody. You can't tell anybody that I had this client, Jim Smith, that I had to file a SAR on. All right. GLB is all about protecting their personal privacy. If you guys notice, if you have a car loan or a credit card or any loan out there, every year you get a statement from this lender saying we share or we don't share information. And if we do share information, this is how you opt out. So it basically, the GLB says we must have an internal program designed to protect and secure all the private information of our borrowers, right? We have all this information on our borrowers. We have to have high-level security. We have to review that security. We have to have somebody as a company officer in charge of that security. And we have to tell people at application, we send them disclosure of what we share or what we don't share, and give them a reasonable opportunity to opt out, which means it's a pretty simple process. Go to this website, sign this form. It's got to be easy, reasonable opportunity for them to opt out on the GLB. All right. So the GLB, Regulation P, protecting personal privacy is what that one's all about. Mortgage acts and practice. This is just a loan that was created after the collapse when we did subprime and all those kind of crazy loans. We now have a lot more things you are not allowed to do or say or mislead when it comes to mortgage ads. So we only had TILA's trigger terms and their few mortgage ad requirements for years. Now we have, with the MAP rule, which is Regulation N, no misrepresentation of any fact. So if you go back and look in your text or on your whatever you guys got on the MAP rule, what you can't misrepresent. So it's all about not misrepresenting information. Like if you say the loan is fixed, like I lived in Orlando for years, and every day they had a 4.5% fixed mortgage, little ad from a savings bank in Orlando. And it was fixed for 1 month. And then it became a 1 month negative amortizing loan after that. But they said fixed because it was fixed for a month. Now, if you say fixed, you'd have to say how long, et cetera, et cetera. So make sure you understand the MAP rule and their limitations and restrictions on the misrepresentations specifically for mortgage advertising. E-Sign Act, right? We e-sign everything. There are some states that are allowing e-signatures for closings. We're not in Colorado doing that yet, but I've every application, every disclosure, every LE, everything I send out that we need signed borrowers, if they agree, and at application, we send them an e-sign act form and they have to opt in. So now they can electronically sign everything. They can withdraw that e-sign with permission anytime they want, and the e-sign permission must be given electronically, showing that they read email and they understand enough about how to read an electronic signature authorization and authorize it before we can start sending them electronic disclosures to e-sign. So it has to be electronically opted in. They can cancel or remove their e-sign authorization anytime, and we accept e-sign pretty much on everything. The Patriot Act, the big thing about us, about Patriot Act. All right, well, let's take 10. We'll take 10, and we'll see you guys back in 10, and then we'll finish up on the regulations and get into some mortgage stuff that I want you guys to take away. All right, see you back in 10 minutes. All right.